Welcome to Talking Trading. I'm Chris Tate. Louise has somewhat bravely handed the microphone over to me for this particular episode, where I will be casting my eye over some of the things that caught my attention during the past week. But before we begin, some community news. First, our general disclaimer. I will be talking about various instruments, but my discussion is of a general nature only, and in no way constitutes financial advice. The other point to note is, because I will be making reference to charts as we go along, you're well advised to head over to our YouTube channel and pick up this episode there so you can follow along. So in terms of what I want to talk about, let's start with a somewhat global view of the Dow. This is a weekly chart of the Dow, and as you can see, it's a continuation of the uptrend that began in November last year. A little bit of an interregnum in March and April where the market drifted sideways. It has then continued on its upward move. Narrowing our focus a little bit, you can see that Friday was a very good session, and the market gives the impression of punching out of that little continuation consolidation pattern it had been in for about 2 weeks. Unsurprisingly, the S&P 500 confirms that, but the interesting thing about the S&P 500 is that it has moved beyond the 5,800 barrier for the first time. So you have a very narrow index moving higher, a slightly broader index moving higher, but there is a general point I want to make about indices making these new highs, and it is that the notion of a new high seems to be destabilizing for people, that the moment price moves to that point, their mind instantly turns to this notion of, well, the market must be about to crash. And if I Googled market crash, undoubtedly I would come across tens of thousands of references telling me the market was going to crash. As we've spoken before, you don't have a situation where you go to bed one night and the market is closed at, let's say, 10,000 points, and you wake up the next morning and it opens at 5,000. That's not how these things work. And a simple investigation of the history of crashes will show you that. Markets hit a high, they drift away from that high, and you get plenty of opportunity to sell, and then they begin to accelerate. So you get warning. My view is somewhat different in that new highs in individual instruments and indices are something to be celebrated because they give an indication of strength. I wish the All Ordinaries would start to hit all-time highs, but at present it does not seem to want to do so, as we'll see. There is a counterpoint to this bullishness, though, and that is the broader US market. This is the Russell 2000. What we are seeing is this juxtaposition between the impact of some very powerful technology stocks in an index like the S&P 500 and the much broader, lower base Russell 2000. You can see that the Russell 2000 has attempted to move out of this congestion zone that it had been in for about, let's say, 15 months. But it then again set up a further congestion zone where it has bounced around. If we narrow down to a daily time frame, the key point here, there's two things to note. One is the immediate impression you get of looking at the Russell 2000 is that it's quite noisy, it's quite choppy, there are lots of gaps in the price. The other point to note is the positive session on Friday. That's a nice big blocky candle. That's a positive sign. That is something that if you were trading this particular index and its constituents, to be pleased with. But you can see the pullback that the market had in late July from about the 2300 mark. That would be the number I would be aiming for before I got any form of excitement about this particular index. In terms of US indices, there's a point I want to make about the impact of individual stocks, and it's something I've spoken about before. Here I've overlaid the NASDAQ 100 over the FANG index. FANG is in the traditional colouring of red and green. NASDAQ is in the blue and grey. There is a scale on the right-hand side, but I want you to disregard that for the time being because that is a percentage change scale and is somewhat irrelevant to what we're talking about. I want you to concentrate on what the look of the price action is in the past few sessions. In the past few sessions, the Nasdaq 100 has gone sideways. The FANG has broken higher. There is a singular reason for this that can be seen quite easily. This is a heat map of the Nasdaq 100. Two things stand out. Nvidia and Tesla, they're counterpoint to one another. This is the performance for a week. So last week Nvidia was up 7.89% and seems to continue that remorseless rise. Tesla was down 11.71%. Nvidia is a driver of the FANG stocks. Tesla is an anchor on the Nasdaq 100. So you have two stocks exerting differential influence on differing indices that shows up when you compare them. You can see this difference in performance between Nvidia and Tesla year to date on this comparison chart here. They are markedly different in terms of the way the market regards them and the way the market views them. I thought I would look a little bit closer at Tesla because it's always an interesting case. It's always interesting to observe the price action of someone who is, shall we say, as, what's a polite way of saying insane, flamboyant as Elon Musk. This is a daily chart. What I've done is the small box you will see are the daily changes for the trading session of last week, and you can see there's only one positive session. The rest have been very poor, and the gap down on Friday, whilst that is an indecisive candle, it was still accompanied by a dramatic lift in volume. Tesla undoubtedly provides trading opportunities for people who have a system that can deal with this sort of behaviour. But it gives you an idea of the impact that a single stock can have on an index, and in some ways can colour your view of that index. In terms of where we are locally, this is the ASX 200, and you can see whilst we have been positive, we're not setting the world on fire. We have this remorseless drift up, we've drifted back from our high, and we're sitting sort of moribund at this 8200, 8225 region. It would be better if there was some form of impetus, some form of trigger to push us beyond that and to generate some form of secular bull market. But part of the problem we have when looking at an index like the ASX 200 is its concentration in certain areas, and this is just reflected in our heat map. You can see the domination of the finance sector. There was talk of a rotation out of finance and into mining stocks, prompted by the movement in gold, but also prompted by a small little upsurge in the price of oil. So there was some talk of this great shift, but it does not seem to have eventuated, because if we look at finance stocks for last week, they're all universally positive. We have a market that is dominated by a given sector. So once again, we come back to this notion that the Australian share market remains a trader's market. It is a special situations market. So in terms of what I'm looking at, the theme for these next few charts is the notion of setup. It is the notion of price going sideways and then needing to move beyond a given point to trigger you in. This is BCI. We can see a sideways trend that has been in place for all of this year. But we are getting some signs of life. We are getting some volume coming back into the stock. But again, we're caught with overhead resistance. The notion here is that you need to treat overhead resistance as binary. It is a wonderful binary signal, and there are very few binary signals in markets as strong. And by that I mean you have one of two alternatives. Price either moves beyond the resistance and confirms your opinion, or it falls away and denies your opinion, in which case you step back from the position. All too often people are somewhat nervous about overhead resistance. The rule is quite simple. If you are able to get your stop to break even before the overhead resistance and you have a signal underneath it, you take it. And we fall back to this binary nature of resistance. If price punches through, you add to the position. If price does not punch through, you exit and you move away square and you look for another opportunity. It is a matter of how you frame the information you are being presented with, so that it is framed in such a way that it presents an opportunity. These, by the way, are weekly charts, so I would be looking at a breakout of this on a weekly basis. This is Maya. Maya is an example of how the popular narrative does not fit the price action. The popular narrative is that the retail world has ended, that it was killed by COVID and never recovered. The price action story is somewhat different. We can see this resistance sitting around just under 90 cents. Granted, the session last week had very poor volume. There was no dramatic interest in the stock, but it presents an opportunity in that you have this very firm overhead resistance and you have price action that is running contrary to narrative. It shows you the failure and flaws within narrative, because narrative is a reflection, by and large, of the information we perceive. That information comes through our perceptual filters. If our perceptual filter, particularly here in Victoria, is that the world is stuffed, then your view of every stock that in some way, shape or form is associated with your view is regarded as a poor particular trade. Price action says something different, and you need to be aware of that differential. You also need to be aware that markets don't think of what has happened and what is happening. They think about alternatives that may happen. So you could build a narrative with something like Maya that says, well, yes, that was the past. The world is now changing. We're now moving forward and we're looking 12, 15 months ahead. And we foresee a different set of circumstances. But again, that is narrative. Always default to the price action. Regal gives us this notion of very long-term resistance, which highlights this notion that the longer the resistance goes on, the traditional interpretation is the more explosive the move out of that consolidation resistance period will be. The prime example of this is if you go back and look at things like De Grey or Chalice Mining, you can find stocks that went sideways for a decade and then had massively explosive rises. So for me, the trigger point for this would be a movement beyond $4 on volume. You can see last week's session had very good volume and was quite solid. This is another one to wait. So we come back to this notion of trading being a waiting game. All too often people see signals like these and they go early. They are preemptive in their engagement of the stock, only to be disappointed. To harp on a point, patience is free. It costs you nothing to wait. You might say, well, there's opportunity cost. I would counter that by saying that the market presents you with infinite opportunities. There will always be another one. Regis is interesting. It is interesting to me because, as I'll talk about in a moment, there has not been a lot of excitement in resource stocks for some time, particularly the larger ones. And I will mention why I think that is in a moment. But we have this firm resistance at around 250. We do have some movement between where we are now and 250. For those who are aggressive, this does give you a window in which you can build a position and then wait to see if we punch through resistance. Again, we come back to this notion that if it does not punch through, step away, square, or with a small loss. If it does punch through, you add to the position. In terms of this lack of excitement that we have with larger issues within the resource sector, and particularly gold, this is a chart of gold which is continuing its run that it began at the beginning of 2023. Once it punched through that 2100 mark, it was away. If I go through a list of domestic gold stocks and I look at their movements, particularly, let's say, for a shorter period last week and how they did, the smaller, shitty end of the market does display some explosive movements, but a lot of that is random noise within a stock that is valued at 1 cent and which has a market cap which is below what you would pay for an average home in Melbourne or Sydney. With the bigger issues where you're looking for solid market cap, very large volume, you're not getting those moves. The reason for that, or my explanation of the reason for that, is simply one of sophistication. Larger size gold miners and explorers have a tendency to hedge, and hedging has become more and more of a thing over the years. So what they do is they lock in their forward costs and they lock in their forward sale price. This means they have a guaranteed price at which they will sell their gold, and they know their cost of production. So they have an equilibrium. But hedging means that you are not exposed to upside. That is the cost of hedging. It removes uncertainty and risk, but it also removes opportunity cost. That is simply the nature of how hedging works. There is no way around that. As miners get larger, they become more sophisticated. As they become more sophisticated, the potential for explosive moves to some degree is capped and removed. And you have to be aware of that. If we drill down and we look at gold on a daily chart, I've dropped my longer term filter on this. You can see that the uptrend is still intact. The filter is green. Green is good. But you can see that the session on Friday was very good, but it is banging against this very short-term downtrend that is in place. Moves like this interest me because whenever you're banging against a downtrend, you either get confirmation of the trend you're in or the trend reverses. Herein lies, again, an opportunity, but again, an opportunity for waiting to see where the price moves beyond this particular trend. In terms of looking at gold miners, there were two that stood out for me. Kingsgate, again, we're back to this notion of we need to wait. But what is interesting to me here is Friday's session. Friday's session is a gap up on volume. Traditionally for me, if this had occurred beyond the previous high of about a week, 10 days ago, it would be an automatic buy signal. That signal is now delayed until we get movement beyond this particular resistance. Resolute I've included because it presents an opportunity for shorter term traders. It is in a channel. For those who are aggressive, channels present an opportunity. If you are capable of having a system that times the bottom of the channel as a bounce point, and you do get this nice range which sits at about, let's call it 20 cents, which on a stock which is 75 cents is a channel worth trading. But one of the points I would perhaps caution is that unfortunately what the majority of people do is they end up buying and selling at the midpoint of the channel and they simply churn the account. You have to have a system that is attuned to doing this and a psychology that is attuned to doing it. I want to finish by looking at crude oil. simply from the perspective of looking at how difficult geopolitical events are to trade. I spoke about this in a little chat I had last week about oil itself, where I looked at this notion that you have to be very careful about interpreting what is occurring in a region that you don't know a great deal about and which everybody assumes has a single national character, and which to everyone else's eyes, or to Western eyes, or let's say ignorant eyes, is uniform. It's not. As we discussed, the notion of there being a Middle East as a uniform bloc is incorrect. The Gulf states are very different to Egypt and Syria. They're very different to Iran and Iraq. And you have to know what that difference means. With the price of crude here, we have this notion that price has been drifting down from 96.98, and it has been slipping down over the past 15 months or so, and just drifting. There's been no real impetus. Even the latest outbreak of appalling violence in the Middle East has not shifted it. If we look at this on a daily chart, you can see the short, sharp move. And this was a short, sharp move. For those who trade very short-term time frames, they would have been able to catch this if they had no longer-term filter in place. A longer-term filter in place for this would indicate that really the only trades you can take are either to be short or neutral. But people have differing ways of approaching the market. You can see we had 2 good sessions. The rest were indecisive bullish sessions. Market then fell back very sharply. Geopolitical events are very difficult to trade because they are by nature unstable, and they are by nature very chaotic. To finish on what I consider the biggest, let's say, geopolitical / economic event, the sudden lifting of the handbrake in China, we see this explosive move up, where market moved from 11,000 to 15,500 inside a week. An extraordinary series of trading sessions in which people did very well. It has then given a lot of that back. This highlights the notion that trading systems and trading psychologies require an idiosyncratic approach for the time frame you are trading. The principles remain the same, but your psychology needs to be matched to what you are seeing and doing. For example, if we go back to our weekly chart of crude, this presents a very different picture. This is the notion of something that a position trader or hedger would look at to prime their positions. It is very different from someone who is a very short-term trader who trades news events or sudden reversals in markets. So in terms of my overall view, my view is simply that markets continue to offer opportunity. That is their reason for existence. If I was to ask someone who had, let's say, an MBA, what is the purpose of markets? They would say to me, well, they're initially a mechanism of raising capital so that companies can expand their businesses and invest. And they are then, after that, a secondary market whereby companies are valued for exchange. I would say bullshit. The reason a market exists is for your enrichment. That's the reason they open. If you needed a metaphor to deal with the market and its uncertainty and the setbacks that we all inevitably face, it is to assume that when the bell rings for the market opening, it opens only for you, and it opens to present you with opportunity. And that each time you are presented with opportunity, you're presented with a series of decisions that you need to make. The nature of those decisions is reflective of your psychology. The good thing about trading is that you are allowed to write your own job description, so that if you are a long-term position trader who trades, let's say, weekly charts, you're allowed to do that. There's no reason you can't be very profitable doing that. If you wish to trade these news events, these very short, sharp movements, or these geopolitical events, you can do that. If you wish to trade gold stocks valued under 10 cents, you can do that. The only requirement is that you have a system and a psychology that matches what you're trying to do.